Good morning, my name is Gavin Richardson, Head of Sales here at Mortgage for Business, and I'm with Jeni Browne, our Sales Director today. We're here on the back of Jenny's presentation at the National Landlord Show at Olympia last week. And the content of the presentation really hit home with a number of our customers and kind of showed the desire to get some more knowledge around the housing market, the buy-to-let market, and a general kind of state of the nation, not just kind of rates and products.
Yeah.
So Jen, it's probably really valuable to start off on your views really on where the buy-to-let market is, and then link that into where you think the housing market is at the moment.
Yeah, so I think just to kind of dovetail on what Gavin was saying, so I was at a show last week presenting to lots of landlords, and I think landlords are feeling really quite disheartened, quite beaten up at the moment. There's been tax changes, mortgage legislation changes, changes around licensing, stamp duty, it just goes on, and I think landlords are feeling pretty fed up. In addition to that, we've got the housing market being quite flat at the moment, talk of house prices falling, and so when I did the presentation, the general feedback was actually it was really good to hear a different perspective other than the kind of attention-grabbing headlines that you tend to find in the press, and actually hear a bit about what's going on from a different angle. And that's why we thought it'd be really kind of nice to share this with people and really just kind of give them our view on what's going on with the market. So in terms of the buy-to-let mortgage market, what you're going to see in front of you is a bar chart which expresses new buy-to-let mortgage lending in terms of billions of pounds worth of lending. And what you'll see is that in 2009 the market clearly tanked. This is just as the credit crisis really got going, and then you'll see a recovery coming up through the years that ensue. Now the key figure here that you really need to look at is the last sort of pillar, as it were, on the graph, which is the Mortgages for Business prediction of buy-to-let lending for 2019, where you'll see that we're expecting the number to drop from just almost 36 billion in 2018 to 32 billion in 2019. Now, when you first see that, obviously the initial reaction is to think, oh my goodness, you know, there's going to be less buy-to-let lending, the housing market is on its knees, we're all doomed, that kind of sense. But actually it's really worth just going into those numbers in a bit more detail and really understanding how this lands in the real world. So buy-to-let lending, as it's expressed here, is really covering off new mortgage loans on lenders' books. So remortgage business and purchase business. But what it's not covering off here is for product transfers. And so the first thing to really note is that one of the reasons you will see this number start to fall is that we've seen a massive uptick in the product transfer market. So a product transfer is where your deal ends, you go back to your existing lender and say, actually, you know, my fixed rate is finished, can I have a new deal? And that lender will then offer you a new rate to remain with them. And this part of the market is only really starting to get going just now for the first time in my experience of broking, which is longer than I really want to admit. And so what we would find, therefore, is that more borrowers are now staying with their existing lenders rather than shopping the market and going elsewhere. So that naturally impacts the number of remortgages that are going on, which affects this number. The second thing to also just kind of highlight really is that what we will see here is that in 2016 there was a kind of peak of buy-to-let lending in the more recent years, and that kind of landed around the time when the stamp duty changes came in. There was a big kind of rush for people to take mortgages out, and these people took, generally speaking, 2-year fixed rates. And those rates ended in 2018, last year, where we saw a fairly healthy £36 billion market. But actually now what people are doing is starting to take 5-year fixed rates. And the reason people are taking 5-year fixed rates is linked into really two things. So first of all, uncertainty with regards to the market going forwards and interest rates, and people wanting some real security of payments, but also with regards to the rental calculations lenders use. Some people are taking 5-year fixed rates because you can borrow more per pound of rental income on a 5-year fixed rate than a shorter counterpart. What that means is that actually people aren't remortgaging as often as they used to as well, so that's affecting that number. And I think really just the third point to say on that is that it would be really remiss of me to try and pretend that the housing market is anything, you know, is really buoyant. You know, it has been a very, very flat market, and that would affect the numbers too.
Okay, so kind of in summary,
yes,
the mortgage market itself, the buy-to-let market, isn't actually declining as the graph potentially might well suggest. It doesn't show product transfers.
yes,
Potentially more customers are doing product transfers because they don't maybe fit on the PRA guidelines for rental stress tests anymore, and those that are remortgaging are going for 5-year deals, because of they don't fit on the 2-year stress test, or because of the uncertainty in the market at the moment.
Yeah, I think, yeah, absolutely. The chart paints a picture, but I think it's always worth looking under the bonnet
The
and what's
underlying.
really going on.
Absolutely. So that's the kind of mortgage market.
Yes.
The housing market obviously kind of holds up the mortgage market in one respect.
Yeah.
And what are your views really on the housing market at the moment? We hear lots of things in the press about it's, not enough houses, or the market's really stagnating at the moment. But there must be underlying factors within that which,
Yes, yes. Okay, so the chart that you'll see in front of you is the average house price kind of index, as it were. And there's lots of different indexes that are published, and that's always quite confusing for people, I think, because they always tend to paint a slightly different picture. But what you will see on the chart here is actually that we're starting to see an upward turn. Now, this chart covers us to March 2019. The Halifax Price Index came out a couple of weeks ago, and what that reported was that house prices had increased from April 19 to May 19 by 0.5%. So we are starting to see, an upturn in prices. On this chart, I think it's also really worth pointing out this is across an average house price across the whole of the UK, and there are loads of regional variations within this. So certain parts of the country have actually done fairly well and held their own. Other parts of the country, and London would be the prime example of this, has been incredibly flat and actually gone down, depending on which report you're reading. So actually the average house price in the UK, I think, is probably looking more positive than this if you took London out of the equation. But across the board, the very good news story here is that actually there is being reported an increase in house prices.
Right. And our customers, I suppose in general, customers are actually, fairly savvy in the market and looking at where from the buy-to-let point of view the opportunities arise, where houses are actually growing faster than the national average.
Yeah.
And those things can be identified on the research that we do here. So if customers are interested in that sort of information, they can get it from us as well. Fantastic.
Absolutely.
So the housing market's one thing, but the rental market is another factor in this.
Yes, yes.
So the housing market graph obviously includes the residential, where you live properties, but the actual rental market is very buoyant, I suppose, in one respect at the moment.
Yeah.
What are your views on kind of where that's going and how it is at the moment?
Yeah, so what we'll see is that that rental figures have been increasing over the last 12 months, which is great. And I was reading a report recently which was produced by Savills, and what they were saying is that because of the lack of stock coming into the the land letting market, and because the demand for private rental property is increasing, actually what they're predicting going forward year on year for the next 5 years is a 2% increase in rental figures. So actually as a landlord, again, I think that's actually a really positive thing to know about.
So the rental market's buoyant. Landlords should be comfortable in terms of actually the rents should either remain the same or they can actually start to increase rents because of essentially supply and demand.
Yes.
From the tenant's point of view, is there any kind of commentary around where tenants are sitting at the moment? There's lots of legislative changes or any factors you want to express there?
I think, there's lots of positive changes going on in terms of the private rental sector. So the letting fee ban coming in, and interestingly actually is a couple of my clients have said that they've had properties on the market to let and they've really struggled to fill them. 1st of June came and went, and suddenly they've got a whole queue of people waiting to come and view their properties. So I think there has been some tenants, understandably holding off taking on a new rental property until this fee ban came in. I think in terms of other legislative changes that are coming in, as landlords, I think we need to understand that the market is trying to support the tenant and professionalise the whole, outfit. And with regards to the licensing changes, the Fit for Human Habitation Act, all this kind of stuff, it's all geared up trying to protect the tenant and ensure that the properties that they're renting are actually good quality stock and professionalise the market.
Alongside all the regulatory changes to support, or some might view penalise the landlords at the moment, but actually professionalise the industry.
Absolutely.
That support is there on the other side to support and protect the tenants as well. So
Yes.
the industry, in a sense, is becoming a lot more regulated, a lot more professional in that
Yes.
regard. We see a lot of customers still, uncertain about looking at SPV or limited company lending compared to lending in their personal names. And one of the biggest factors really is maybe a lack of choice that they saw in the number of lenders out there. And there's lots of change in the last 6 months. Where's your kind of view on how the industry is actually going in terms of the limited company to personal name market?
In terms of the specialist buy-to end of the market, and this is the limited companies, the HMOs, the multi-units, that kind of portfolio landlords, that is a part of the market which is growing. And actually in terms of the lending figures, while we're predicting that buy-to ending will come down this year, actually the specialist end of the sector is a growing part of the market as more people want to grow through limited companies and chase deals through HMOs and all that kind of stuff. So what we're also seeing is more landlords come into that end of the market because it's a more lucrative end of the market in terms of the premiums you can charge the borrowers. What I would also say on that is that I bought my buy-to-let through a limited company just over 3 years ago. So I snuck in before the stamp duty changes, came in, and I then remortgaged my 3-year fixed rate a few months ago. And actually, while nothing really has changed in the market in terms of interest rates are pretty much where they were at that time, I was able to get an interest rate which was 1% lower than it was when I took it out 3 years ago, and I paid less fees. So, it is a space which is becoming definitely more competitive. There is a difference between our cheapest personally owned vanilla property buy-to-let rate and our, limited company multi-unit rate. Of course there is, but the difference in margin is definitely compressing as time goes on.
Okay. And in terms of providers within the market, what are you seeing now?
Yeah, so we did see in the first quarter of this year 3 lenders come out of the buy-to-let market. So we lost Secure Trust, Amicus and Magellan Home Loans. And there was some really sensationalist reporting going on at this time, which, it happens, of, question marks being raised. Are we going into another credit crisis? Do the banks have no money? Are we on the kind of precipice of another credit crisis? And that simply isn't the case. So the banks are really well capitalised. They are really, really keen to lend you money. The number of lenders we have coming through our doors saying, we want to lend more money, what can we do? Do we need to change criteria? How can we attract more business? So it isn't that. What happened was, with those lenders was that when they're looking at the cost of their funds coming into them and the rate at which they could re-lend it out on and the kind of space in which they're operating and how competitive it is, they simply weren't able to commercially make the numbers work for them because it is a competitive space. So, we're not going to make enough money doing this, we're just going to bow it out. And that is all it was.
Yeah.
Those lenders probably will come back to market at some point.
Yeah.
But what we have also seen is we saw 2 new lenders come to market in this quarter, and we expect that to continue throughout the year.
Yeah, and lenders come back to the market at a rate.
Absolutely. Free mortgages went away, they're back in now, So it's a market where, I think it has still more room to grow in terms of the providers.
Okay. So we're seeing lots of change, we're seeing lots of lenders come to market, lots of lenders actually get their house in order and then come back to the market, and some lenders decide it's not for them. But in terms of products available to our client base, we're seeing quite a lot of change there,
Yes.
both positive and negative, I suppose, in one respect. And again, your views on what's changing, I suppose, for lenders, some are simplifying, some are going more into the specialists.
Yeah.
Where do you kind of see the lenders really taking a leap?
Yeah, I think, so when we look at, one of the things that we track with our buy-to-let index is the number of mortgage products available. And what we've seen from the last quarter in 2018 to the first quarter in 2019 is the number of products available really reduced. Now that's partly due to a couple of lenders coming out of the market in the first quarter, and the new lenders coming in being this quarter. That had a knock-on effect in terms of the numbers available. What we've also seen is that some lenders have, when we look at their product suite, an enormous number of products available. So they have products for HMOs, multi-units, personal borrowing, limited companies. They have 60, 65, 70, 75, 80% products. They have products with flat fees and percentage charge fees, people with adverse credit and absolutely clean credit. And some lenders' product suites can amount to, I'm not joking, like maybe 50, 60 products.
Yeah.
And so as a broker, and also for the borrower, it is incredibly confusing to understand actually what you're applying for, what your costs are really going to be. And I think lenders have started to realise they've tried to be all things to all people and start to condense things to make their offering more palatable to people. So we have seen lenders sort of reconcile their offering and bring the number of products down. So that's reduced. So I think we've seen a reduction in the number of products, but I don't think that's born of, again, less appetite to lend. It's just more about lenders actually thinking, hang on, I think we're kind of missing the point here.
Yeah.
We want to become more kind of transparent in what we're offering and therefore reviewing things and condensing them down.
Yeah, hopefully just simplifying a specialist market.
Yeah.
Which would help everybody.
Absolutely.
Fantastic. Okay, so we talked a lot about the kind of market, we talked a lot about where lenders may be coming in, and we talked a little bit about some legislative changes. Section 21 is probably quite topical at the moment, and I can see the tense as it comes in, but there's lots of talk about that. What are your views on where that is at the moment and what's likely to have, what impact it's likely to have on landlords and tenants, I suppose?
Yes, so the abolishment or the proposed abolishment of Section 21, so we're in a consultation period at the moment, so we don't know if it's going to happen, if it does happen, what is the kind of trade-off for that? So will there be a different piece of legislation brought in? Will an amendment be made with a different option for landlords? We just don't know how it's going to fall out in the long term. Scotland lost their equivalent of Section 21 last year, and I don't know about you, but I don't remember a single lender coming into us since then saying, actually, the Section 21 of Scotland has gone, so we're not lending in Scotland anymore.
See more lenders go into Scotland.
Exactly. So in terms of how we think that will affect the buy-to-let market if Section 21 does actually go, I think it will raise some question marks around making sure that everyone is protected, but I don't think lenders are going to suddenly pull out of the industry. Interestingly, Moody's, the credit rating agency, published a kind of article which said actually if Section 21 goes, and this is without any kind of caveat of but what else is brought in, then buy-to-let would be perceived as a more risky asset class, and the knock-on effect to that would be that the cost of funds may go up slightly. But again, this is all speculation, we simply don't know.
No.
In terms of how if Section 21 was abolished and how it would affect landlords and tenants, I think it's too soon to say. We're in a consultation, we don't know, like I said, what the kind of trade-off will be to that, what provisions we put in place to compensate. So I think, for now it's just a case of business as usual, and let's see how it lands.
Yeah, you can't do any more than that really at this stage. Section 21 is one thing, Section 24 is obviously the other in terms of we're in the last or the final year between landlords seeing the full impact of the implications of Section 24. And we're seeing quite a lot of changes in the industry and clients looking at ways maybe to avoid paying all their stamp duty or mitigate some liabilities or what they can do to save tax in certain areas.
Yes.
And whilst we're aware, schemes are available or schemes are recommended, it's really critical that the tax advice is imperative in the early stages of a client's decisions.
Yes.
And you must be seeing quite a lot of change in clients coming to you with, I've got this idea, and my accountant said this. What are your views on what's possible, what's feasible, what they should be considering?
Yeah, I think so. What we find is that clients are coming to us, and so if you have properties in your own name and you simply want to sell them across to a company and incorporate that way, that is absolutely no problem. If you're going to go through one of the kind of structures that are in place in terms of running things as a partnership, lenders tend to be quite comfortable with this, and then taking the loan out through the company once you exit the partnership phase. So that's something that we're seeing is kind of working okay. What there does seem to be a kind of slurry of at the moment is people who are using various trust structures where the ownership of the property essentially passes across into a trust. Now, we're not tax advisors here, and it would be really, really wrong of me to comment in terms of how this would land with HMRC. What I can tell you is that from a mortgage perspective, lenders are incredibly nervous where borrowers have these kinds of arrangements in place, because what we simply don't know and what has not been tried and tested is how this will land in the world of HMRC once it goes before them and one of these actually gets tested in real life. And so the lenders are very, very concerned that the people who have these arrangements in place may come unstuck down the line in terms of their tax position. Now, like I say, it's not for us to comment on whether that's going to be the case, but what I can tell you is that we did some research and spoke to every single lender that we deal with, and of those lenders, only 3 came back saying they can consider lending to a borrower where they have one of these trust structures in place. And the caveat there was very much, as long as the trust structure was set up pre the Section 24 amendment announcements were made, i.e. this has been done not to avoid tax, it was something that's very a long-standing arrangement.
Yeah. I think 3 out of 20 lenders that lend in the limited company market is a very reduced market. Probably also worth pointing out that previously on Section 161 on the Incorporation side, HMRC used to give pre-approval to these types of transactions, and they now no longer do so, but they can retrospectively review to make sure you've got it in order. So it really does highlight the implications of not taking sufficient professional tax advice.
Yeah, I mean, I think with anything around these kinds of lines, the absolute key message is get the right advice from the appropriately qualified people.
Fantastic. Which brings us nicely to a close in this respect. There's obviously a lot of content and a lot of information in Jeni's presentation and in this brief talk. If you'd like a copy of Jeni's presentation, then please let us know. Contact Jeni directly on jennyb@mortgagesforbusiness.co.uk or give us a call on 0345 678 678 07788